You are watching Property TV.
Hello and welcome to Property Question Time. My name's Stephen Galpin and this is the programme where you can have all of your property related questions answered by our team of experts. And joining me today is Kam Dovedi, founder of Premier Property Group, Investors and Mentors. Welcome to you, Kam. Tony Gimple, MD and founder of Brand Entrepreneur, who are private rental sector commentators. Welcome to you, Tony. Hope you both had a good trip in today. No
not
dramas.
too bad. It was all right.
Good.
Yeah, we're here.
Okay, well, we're going to get straight on with the questioning. And Tony, you're going to go first. I'm considering entering the buy-to-let market and wondering if I should buy in a newly formed limited company or in my own name. I ask this because I read many experts recommend the limited company route, but my potential lender is insisting that if I buy in the name of a company, I would have to personally guarantee the debt, which seems to negate some of the advantages of using a company. Any advice, please? I know we've had this question many times before, haven't we?
And no doubt we'll have it many times again.
But it does change from time to time, the answer.
Yeah, because there is no ultimate right answer. It depends on an individual's circumstance. The bigger question is, why do you want to do it in the first place? Why are you going into buy-to-let? And it's only once you've understood your own motivation and you know your short, medium and long-term goals, then you can start to take advice as to what's going to be the best structure for you.
Okay.
In terms of own name, limited company or something in between, the veil of incorporation is very easy to lift these days. In the past, you could borrow the name of a company, wind the company up, and the lender would, be left holding the baby. These days, lenders have caught on. So if you are going to buy through a company, you have to give personal guarantees because at the end of the day, they want their money back. Sure. For most people starting out, I would typically say start in your own name. That's regardless of whether you're a basic, higher or additional rate taxpayer. Get some experience, work out what is the right thing for you to do as an individual, and then start to plan forward.
I'm guessing that it's rather easier to go from a private entity to a limited company rather than from a limited company back the other way.
There is no economical way back because you end up having to wind up the company, remortgage from the company name to a personal name. There can be all sorts of horrors.
So Tony, how critical is your proposed exit strategy to this?
It's everything.
It's everything.
It's everything. Nothing lasts forever. We've seen that during the last couple of years. It's been really, really tough. Is it the entry strategy? Is it the exit strategy? If it's just you as an individual, no other half, significant other, whatever, kids, and you're just doing it to make a hell of a lot of money for yourself in the short term, well, frankly, whichever way you do it, you'll enjoy it whilst you can, and then it'll get wound up when you're gone. If, however, you've got family, children, or it's a business with charitable objects, social sector, say, then knowing where you are now and where you want to be in clearly defined periods, from tomorrow through to when you fall off your perch, is absolutely critical.
Okay. And from a taxation point of view, is there much difference for your tax situation on your rental income to a limited company as opposed to coming to you personally?
Yeah, lots.
Okay.
Yeah. Limited companies seem to have been the fad. You can deduct all your finance costs, etc., etc. Trouble is, you end up paying tax multiple times. You've got your corporation tax.
For the corporation tax and your own when you draw it out, yeah.
And you just got to look at some of the commentary on various antisocial networking sites, particularly for the sector. And you could easily end up paying well north of 60% in tax by the time you add up all the different bands you're paying. You've got corporation tax, income tax, dividend tax, director shareholder, loan account, all sorts of issues, auto enrolment. How many slices do you want to pay before you actually get to the bottom line? Whereas an individual, you can mitigate Section 24 effectively, not pay more than basic rate tax on day-to-day income. Excuse me. And typically, doing it the right way within 2 tax cycles, the assets will become free of inheritance tax because it'll qualify for business relief.
Okay, great stuff. Well, fair bit to absorb there.
Yep.
You got any thoughts on that, Kam?
So yes, so Stephen, there can be 2 camps that people can look at this in. So where investors already have properties in personal names, then they can use Section 24 to their advantage. So namely the replace and renew allowances. So where they're buying tied properties, building assets, thinking of it as a momentum investor, and they can use those to mitigate taxation correctly according to HMRC's guidelines. Of course, get advice from your accountants, etc. But you'll normally have to be in the conversation where you can mitigate those. So that helps with properties that someone's already got. With properties, someone starting new or moving forward, like we're doing, you can be investing in limited companies. Things to be aware of in limited companies is, as the person asking this question says about giving a personal guarantee, you are going to have to give a personal guarantee, whether it's a limited company or whether you're buying a personal name. So that's fine. I mean, they're lending you money, lenders lending you money, so they're gonna expect that, and that's fine. So there's that. The other thing with limited companies is to be aware of is that how many properties are you actually going to be buying in the limited company, because you are going to have accountancy fees. So if your intention is only to buy 1 or 2 properties in a limited company, you've got to think of that cost that you're going to be incurring. However, if your intention is over a period of time to be consistently buying and creating a portfolio for yourself in a limited company, then it makes sense.
Those company management fees dilute, don't they, obviously, with the more properties?
Exactly, yeah. So you're minimising your costs, and that becomes a fixed cost. So there are things to think about.
Okay, well, it seems to me on that one, I think you'll both agree then, top rate accountancy advice is necessary these days before you go entering into this market. And a very clear strategy, I think, would be with the expression of going into the business and also coming out the other end.
Yeah.
But there we are. Okay, thank you both very much for that. Kam, your question. With the return of normal tenant evictions for non-payment of rent during the COVID period, do the panel think that the courts will offer any latitude to tenants genuinely trying to catch up with arrears, and that they may in turn be allowed to be able to avoid eviction by offering a plan to the court or to the landlord? Do you think there's going to be any latitude here?
Well, that's a very interesting question, actually. And of course, what we suggest and what we do is that becomes last resort. So evicting a tenant is last resort. And what I'm hearing from a number of our letting agents, what we're finding is, which is quite interesting, is that when it actually goes to court, the eviction goes to court. So you're serving Section 21, where of course people are aware that you don't have to have a reason why you're evicting a tenant. The courts are actually turning back and saying, well, sorry, we're not going to allow you to evict the tenant, even though it's Section 21. So that's quite interesting. That's never happened before, but I'm hearing this from our letting agents, where they're managing a number of our properties and they're managing other people's properties. So that's happening. Also, my point of view is, if you've got a tenant that's actually paying you, or they're a little bit down on their luck, or whatever reason they haven't been able to keep up with their payments, then what we always do, and what I would advise anyone, is to create a mutual situation where you can navigate through that and make sure there's create a payment plan, is what I'm saying. Create some form of payment plan, understand the situation, be in that person's shoes and actually say, why are they not paying? Are they just stubbornly not paying? Or is there a situation where it's impacted their finances? Can you help them with that? while you continue your business, can you create a payment plan? So that's always, the mediation is always what we go for first.
But I think there's also a consideration there, Cam, isn't there, that you shouldn't encourage or allow your tenant to just get deeper in debt without the prospect of it really being sorted out at some point in time.
Exactly.
I think that's a dangerous situation, isn't it?
Agreed. So you got to nip it in the bud. You got to have the conversations early on as soon as those payments haven't come in. So, for example, since COVID, and COVID's, if anything is good to come out of COVID, is that our systems have become even tighter. So the way we deal with this is that we'll check in to make sure that the tenants have paid. Typically, we use letting agents, and we make sure that the payment has come into the letting agent. So that's the first check. Then we also check the payment coming into the bank as well thereafter. But as soon as we find out that a payment hasn't been made, we want to know. You want to know why that is, so that you can find out what is that situation. What is it? Has that person been paid late by their employer?
Sure.
Is there what's the circumstances? And you really want to, and you're quite right, you really want to find that situation straight away so that you can mitigate it. The longer you leave it, the more of a problem it becomes. So if you can sort that out quickly, keep your finger on the pulse.
Great stuff. Okay, well, that's all we've got time for in this half of the show. So join me again after the break when we'll be answering more of your questions.
You are watching Property TV. You are watching Property TV.
Hello, welcome back to part 2 of Property Question Time. And today I've been joined by Tony Gimple and Kam Dovedi. Welcome back both. Tony, your second question. I have some investments made through crowdfunding into a residential development. As I own the shares rather than the property, can I create a pension fund with this investment? And what would be the reinvestment restrictions and consequences of early realisation of that capital or the profit taking?
Well, you've just bought shares in another company is effectively the question. The short answer is it's not earned income, it's not pensionable income. You're just an investor holding shares in a business.
Does it matter that it is a property business, that it's owning a residential property?
Well, you're not owning it. You're not getting any income from it.
The third party company is?
Correct.
Okay.
Yeah. So it's a bit of a moot question.
So why can't you apply that to your pension then?
Well, there are all sorts of questions wrapped up within that. What you can potentially do, and this will depend on your overall pensionable situation, is perhaps look at SAS, self-administered schemes, SIPs, and perhaps invest in a REIT, which itself invests in property.
Okay.
It's one of those questions that on the surface seems simple, but underneath it, it's hugely complex. So all right, let's put it this way. Forget what the underlying asset is. You buy shares on the stock market, and that company owns property, commercial property or social housing or any other variation on a thing. Can you put that into a pension? Typically not.
Right.
All a pension is effectively an annuity for when you want to hang up your spurs and sit back and relax a bit, have some fun. The rules have been tightening up on when you can take pensions, how much you can take as lump sums, and all sorts of, and there's a cap as well. So you have to look at the question with a much broader brush, and understand an individual circumstances.
Well, do you know something? I just talking to you two guys today, I'm realising that as every day goes by, we need more and more professional advice, don't we, on the activities that we undertake. I mean, I know I've spoken to you, Kam, before on this subject of pensions, and I know your view is that whilst you can't create an individual pension fund through residential property, there's no reason why residential property can't actually be your de facto pension. And there's that subtle difference, isn't there? So, but again, it does come back to this advice of where you're starting from and where you're going, doesn't
Yeah,
it?
look, it's what should the advisor be selling? It's that which they know and you don't. The worst thing you can ever do is go to a mentor, a lawyer, an accountant, an insurance broker, whoever, and say, can you do this for me? And the worst answer they can ever give you is yes. Well, hang on a second. You may be very good at what you do in the day job, but have you given them enough information for them to act under your instruction? It needs to be a conversation. The same as we were talking in the first part of the program about landlords and tenants when they get into arrears. You have to have a conversation and work out what is it you're really trying to achieve, because it's not just the simple thing about I need a pension. No. Why do you need it, and what have you got already, and on from there. I
do think one of the advantages that we've seen out of COVID, although that very few and far between, is that it has created better dialogue between landlord and tenant, between business person and their professional advisors. There's been much more interaction, hasn't there, and useful conversation. Do you agree with that, Kam?
Yeah, I agree with that. And really, what we've got to be aware of is that you've got to be part of that conversation. In my experience, you can save yourself a lot of money from accountants, tax advisors, so on. However, it's usually you bringing to that tax advisor or that accountant, etc., saying, by the way, can I do this? How about, have you had a look at this? And they go, oh, yes, I have. Oh, yeah, we can do that. Well, why don't you tell me then in the first place? So it's really important, I feel, that we, all of us, should be part of the conversation, not knowing what the actual professional day-to-day work is required. That'll be the tax advisor, etc. But you need to be the person that has enough information, enough knowledge to be in that conversation, to direct them.
You're absolutely right. It all comes down to the right questions, doesn't it? I know I sat in court for many years as a magistrate, and I can't tell you the amount of times somebody said to me, my solicitor told me this. But then I have to say, well, hold on, what was the question you asked your solicitor? That's the real key to it. And it's the same, I think, with financial advice, isn't it? What are the questions you're asking? Are you asking the question that's really relevant?
Yeah, I mean, SIPs are so exciting. There's so much you can do with SIPs and pensions as an entrepreneur's point of view. SASs, similarly, different rules, different regulations, again, very exciting. So many things that you can do. You can literally run your lifestyle through these pensions correctly, according to the rules. And of course, as you mentioned, you can create portfolios like we've done, where that, in effect, does relate just like a pension as it grows and income coming in, done correctly. It can work really well for you. So there's, yeah.
Okay, good. All right, Kam, on to your second question. I'm a buy-to-let landlord, and this is one I think we're hearing a lot. I'm a buy-to-let landlord, and throughout the period of the various lockdowns, I've lost a number of tenants. Looking to replace those tenants and filling the associated voids is causing a bit of a problem. I've been looking for a new and reliable letting agent. I noticed that some are offering guaranteed rental incomes if they are appointed as my agents. Are these offers genuine, and are there any associated pitfalls or hidden costs I should look for? Just all seems a bit too good to be true. What do you think?
Yeah, again, another great question, actually. So the thing is, if you get the wrong letting agent, they can destroy your property business. We've got to be aware of that. If you get the right letting agent, they can really be a really core part of your team to help you. So there are letting agents where they're offering guaranteed schemes. That's because they've got relationships with third parties and corporate entities. Yeah. So we, sort of with social housing providers, with various other corporate entities as well. So they've got their own relationships that they've got there, which they can bring to the party. So you can get guaranteed rents, and the way they make the margin is by extra fees, golden handshakes, if you want to call them. So they'll get some of that, or there might be an increment of the income. So they'll make their money that way. So there are some honest services, but you do need to check out the people that are honest. So when it comes to letting agents, here are some things that you can actually be checking for, that we check for. So firstly, have they got the right accreditations? We've got the normal accreditations that every letting agent requires. So they've got to be part of a redress scheme, etc. They've got to be part of CMP, client money protection, and so on. And then the next level of accreditations, are they a part of a body such as ALA or NALS and the other various ones that are out there? Yeah. So that shows good faith that they're actually doing something in their business to be a good letting agent. Also, under the radar, what we also look for is letting agents that are people like us. So what they've done is organically, they've built up a portfolio over a period of time. They've got really good at what they do. They're a wealth of knowledge, and they are usually the independent type of letting agents. So they've been 20, 30 years plus in the business, and those letting agents are worth their weight in gold because they will have a lot of experience. It's not just what's written in the book, it's what's written within the lines of that book because it's their personal experience, and those will really help. And yes, you can get these guaranteed rents.
Kam, I've got a question for you. You're a man with a significant portfolio of property, so you apart from your business side, you'll have an attitude to this, I think. A lot of what I'm hearing from a number of the developers and freeholders is that what they found, where there's been rental voids during COVID, people relocating elsewhere or coming out of the city because they no longer need to be next to their job, sort of thing. They're having to reduce their rents to fill those voids. The freeholders then saying, well, hold on a minute, you're actually debasing the worth of the building because we're getting a lower type of tenant, one that can afford probably £800 a month is grossly different to somebody who can afford £1,200 or £1,400. So as an experienced landlord, would you say, no, keep your prices there, keep your rental criteria there, the standards there, or would you reduce to fill a void?
Yes, great question. So we don't invest in those types of properties, and obviously the past is the past for people. With hindsight, everyone can do better, can't they? Right? But if someone is in that situation, we're noticing that. I mean, it gets even worse actually. Another one is social behaviour of people. So in places like Manchester or other places, where they've built up all these lovely Canary Wharf looking type buildings, where they're looking for the professional type of tenant, and as you just said, they can't fill them. What they're now finding is they're renting out to, for example, local housing allowance tenants. Nothing wrong with local housing allowance tenants, but there's a certain persona for that building, and they're bringing in individuals which have different types of social scenarios. Sure. So some of those types of tenants will make sure, in effect, that the rest of that building doesn't get rented because nobody else wants to move in because they're from a different type of social type of
background.
So the quick answer I'm looking for. So do we go for the money or do we go for the standards?
Yeah. So if someone's in that situation, then it's a case of you got to cover your costs, and you got to do whatever you got to do, and that would be reducing rents. That could be giving some people rent-free period to come into those environments. That could also be selling that portfolio, liquidizing that capital, and moving to somewhere else where you can monetize that. Okay. What we do is we make sure we check all this right at the beginning. So we make sure, specifics, is the rental yields going to be a minimum of 5.5% in large cities, and is it going to be a minimum of 7% gross yield in smaller satellite towns? What type of stock are you actually buying? Is it sustainable? Who are your demographic? Who are you actually dealing with? Is it local housing allowance tenants? Because we've got some lovely local housing allowance tenants which pay the rent on time, which the council pays for. We've also got very good professional tenants who require a certain type of stock, and when you provide that to them, they're happy with that. So it's about your area. It's about making sure the yields are right. It's about having the right type of stock.
Okay. All right, well, thank you both very much for that. So a big thank you to Tony Gimple and Kam Dovedi. Thank you both for coming in today. Great content, great answers. Thank you. I'm Stephen Galpin. Join me again next time on Property Question Time.